A CEO can use this to fool you. And that is this idea that we are at all-time highs. Now, that could be all-time highs of revenue, profit, stock price. They will sometimes point to these sort of metrics to say that they are doing well, but you are being fooled. Now, let me explain why that is. When you invest in a business, it has a certain amount of earnings. As it continues to generate earnings, it will usually retain a portion of those earnings. The earnings it is retaining go back into other investments that should generate more money too. And so because of this, which we could say the invested capital base tends to increase over time, you would expect them to earn more dollars of revenue and profit over time, which should translate to a higher stock price. And so over time, things should just grow generally. It is not because of any skill by the manager or the CEO. It is just an expectation of the fact that the business has more capital that they are deploying. And so that is something they can kind of fool investors with. Now, instead, what you should be looking at in order to kind of judge the success of a CEO as a capital allocator is their return on invested capital. Now, that is a figure that you cannot easily gain. And that, for simplicity, could be thought of as profit over invested capital, where invested capital is going to be your equity, your debt, less whatever excess cash the business has. And that is how much money basically the business is using to make more money. So for a simple example, let's say you have $1 billion and you gave it to someone who was going to manage that $1 billion for you. Okay, that person just put it in the bank. And for simple math, let's say the bank is offering 5% interest. That means every year you are getting $50 million in interest. And so at the end of year one, your $1 billion grows to $1 billion and $50 million. Okay, well, the following year, without doing absolutely anything, you would make more than $50 million because that $50 million that you made last year would also make 5% the next year, which is going to be $2.5 million more dollars. And so by simply just sitting in the bank and growing it a little bit, it made more money, this kind of incremental $2.5 million. Now, you shouldn't go to the person who put the money in the bank and say, oh my God, you're such a genius. You made me even more money this year. That was to be expected. When your capital base grows, it is expected that the incremental capital also generates a return. And so when we go back to thinking about a CEO of a Fortune 500 company who's lauding that they now have the highest profit they've ever had, that is not actually that impressive because this year you had much more money to make money with than last year. And so that is something that they will try to fool you with. Do not fall for it. Instead, focus on the return on invested capital. And if you want to be even more sophisticated, look at the incremental return on invested capital, which would be the return on invested capital for the additional dollars they deployed in a given period. Now, what that would mean though is, let's say you run your ROIC math for a business, and then you want to look at what they earned the following year and how much that incremental money they earned is earning. And so if that number is going up, that means the manager is doing a superb job. If that number is going flat, it probably also means they're doing a pretty great job, because if it is a high ROIC, it's pretty hard to maintain that. If it's going down a little bit, sometimes that can be acceptable as long as it's a number that's pretty decent, call it, at least low double digits. And if it's much lower than that, then probably a pretty poor job, but it depends on the industry. And so that is just kind of a rough way of looking at it. The other thing though that you should look at and you should push for as a shareholder is that the way management is incentivized should take this into account. And so again, just by virtue of the fact that there's more money every year in the business, you would expect it to earn more money every year. And so there shouldn't be sort of incentives that do not take that into account. Very often, managers may have RSUs or stock options, something else that's tied to a financial metric, but it is not tied to the return on invested capital. And so again, that is going to be a really important thing for people to look at. Now, just for one last simple example to really hit it home, let's say a business is making $1 billion a year, and somehow they were able to raise $10 billion in cash. All they did with that cash was just stick it in the bank and earn 5% interest on it. They would have $500 million more dollars the following year. Now, if you included that in earnings, it looks like their earnings just went up $1.5 billion. Would you think that this CEO was a genius? No, all he did was raise more money. He didn't actually deploy it into any sort of projects that actually generated more economic value than you could get by just parking your money in the bank. And so make sure you do not get fooled by this. Look at the ROIC. And if you want to understand more about ROIC, check out this video where we go into a lot more depth explaining it, understanding why it's such an important metric, and really what is going to dictate your return as an investor over time. If you found this video helpful at all, go ahead and hit like or subscribe and drop any questions in the comments below, and we will cover it in future videos.